When you have some money in hand, is it better option to pay off your debt or invest the money for higher returns? Well, it's not a straightforward decision. Today we're going to look at argument in favor of against investing and paying off your debt so that you will be better equipped with all the information to make a good judgment on your financial life. People who find themselves with extra cash can face a dilemma. They use the money to pay off or at least substantially pay down that pile of debt they have accumulated? Or is it more advantageous to put the money to work in the investments that will grow in the future? Either choice can make sense depending on the circumstances. So what are the key differences in investing versus debt repayment? Investing is a way to set aside money for the future, ideally in an investment vehicle such as stocks, bonds or mutual funds that will grow in value over time. Debt, on the other hand, represents money that you've already spent and that a lender is charging you interest on. Left unpaid, the debt will grow and grow, with interest charges adding to your balance and incurring interest charges of their own. Let's now look at the case for investing. As a general rule, if you can earn more interest on your money by investing it than your debts are costing you, then it makes sense to invest. For example, if you have a mortgage with an interest rate of 5%, the stock market index fund that is returning 10% a year, you'll come out ahead by investing your extra cash in the index fund. On the other hand, if you have a credit card debt at 20%, you would be better off putting your extra cash towards paying that debt rather than investing it in the index fund. Unfortunately, it isn't always that straightforward. Investments can be volatile. The index fund might be up 10% this year, but down 10% next year. While there are investments that pay a guaranteed interest rate, such as bank certificates of deposits and US Treasury bills, they tend to have low rates of return that rarely exceed the interest rates charged by credit card companies and other lenders. Another factor is more psychological, your risk tolerance. If you are comfortable taking the gamble that your investment will bob up and down with the markets, sometimes rising in value and sometimes losing value, then you are a better candidate for investing than someone who would lie awake at night worrying what about the market might do tomorrow. Now let's say the case for paying down the debt. There are several good arguments for choosing to pay down debt rather than investing. The first, as mentioned above, is that you might come out ahead if your debt carries a relatively high interest rate. That's especially true with credit card debt. The average interest rate on credit cards is approximately around 19%. Few investments can match that rate of return. Another solid reason to pay down debt involves your credit score, a number that can be very important if you want to borrow money in the future, such as mortgage or a car loan. Having a low credit score can mean paying higher interest rates if you can get a loan at all. Your credit score can even affect other aspects of your life, such as the premiums you'll pay for insurance, whether a landlord will rent to you, and even whether an employer will hire you. Credit scores are based on a number of factors. In case of the most widely used one, the FICO score, your credit utilization ratio, which is the amount of credit you are currently using compared to how much credit you have available to you, accounts for a significant portion of your score. So for example, someone whose credit cards are all maxed out is likely to have a considerable lower score than someone whose credit cards have been paid off or at least paid down to a more reasonable level. Paying off debt, especially if you have a lot of it, can be a smart move for that reason alone. As with investing, psychology comes to play here too. If you are losing sleep over your debts, then you could be better off repaying them, even if you might get a better return on your money by investing. Let us now see the case for doing both. Paying down debt versus investing doesn't have to be either or decision. You can and sometimes should do both. For example, if you don't already have an emergency fund, you might want to use some of your money to create one, while using the rest to pay down your debts. A good place to keep your emergency fund is low risk and highly liquid investments such as money market mutual fund. Let's now see how to pay off debts. If you have decided to use your spare cash to pay off your debts, then the next question is how to go about it. Enough money to cover everything you owe? The answer is pretty simple, just pay it off. However, if you don't have that much cash to spare, then you need to prioritize. Generally speaking, you'll get off debt faster if you start by paying off your debt with the highest interest rate first and then working your way down from there. For example, if you have balances on two credit cards, 20% and the other charging 15%, tackle the 20% balance first. In the case of credit card debt, you may also have another option. Transfer your balances to a card with a lower interest rate and then pay them off. Some balance transfer credit cards offer promotional periods of 6 to 18 months when they charge 0% interest, which can help you pay your balance down faster since you won't be incurring additional interest. Still, another option is a debt consolidation loan from a bank or other lender. The way that works is that you borrow enough money from the lender to pay off your other debts. Now you just have one debt to worry about, ideally with a lower interest rate than your prior debts. You can then use your extra money to begin paying off that loan. Let's see what you should be doing if you're really deep in debt. If your spare cash won't begin to make a dent in your debt, then you may need to consider some more drastic measures. First, if you are having trouble making even the minimum monthly payments on your credit cards or other loans, contact your lender. They may be willing to reduce your minimum payment or the interest rate on your debt. Second option is hiring a reputable debt relief company to handle negotiations for you. This is an area that is widespread with scams, so make sure you know who you are dealing with. The bottom line is, some extra cash is an enviable situation to be in. Whether to invest that money or use it to pay down your debt is a decision that only you can make. But either use is better than simply spending it. Whichever course you take, you will be in a better financial situation than you were in before. Let me know your thoughts and subscribe to our channel so that you don't miss any of our videos on personal finance and you get notified.